Hello and welcome to the GTR Asia 2021 Virtual Trade Leaders Roundtable, in which we welcome senior representatives from across the industry to reflect on the latest trade developments and discuss the opportunities and challenges ahead. My name is Eleanor Rack and I'm a senior reporter with GTR. Leading today's conversation is Kai Fair, Global Head of Trade and Working Capital at Standard Chartered Bank. And joining him are Peter Jamieson, Managing Director, Head of Trade and Supply Chain Finance for Asia Pacific at Bank of America, Sriram Muthukrishnan, who is Group Head of Product Management at DBS, Kanika Thakur, Head of Asia Trade at Citi, Atul Jain, Head of Trade Finance and Lending Asia Pacific at Deutsche Bank, Nicolas Cotonnet, Managing Director and Head of Global Transaction Banking for Asia Pacific at Banco Santander, Azim Wali, Head of Product for Asia and Oceania, Transaction Banking for Office for Asia at MUFG, Ajay Sharma, Regional Head of Global Trade and Receivables Finance at HSBC, and Ed Alderino, Head of Global Transaction Banking for Asia at Lloyds Bank Commercial Banking. So thank you all for joining us today. I'm going to hand over now to Kai, who's our moderator, who will kick us off with our first question.
Yeah, hi everyone. Good morning, good day, good evening, and welcome the who is who of trade finance here in Asia and globally. Thanks for joining us. Eleanor, I immediately go off script asking everyone the question, how was your trade year so far? Depends a little bit when your year ends. Can I have a quick signal ballpark year? You knocked it out of the park. Or are you struggling? This sets us up and a little bit the temperature for all the remaining questions. Just a quick round. Is that a good year for BOA? Peter?
Yeah, thanks, Kai. A very strong year. And I think as we talk a lot about what we're seeing in trade flows, I think we've certainly seen that reflected in our business. So I'm very optimistic about this year and particularly about next year.
How's DB doing?
Doing very well, thank you, Kai. So we are on track this year for our fourth year of positive growth. And we feel really good about that because that's just kind of reaffirming a lot of the decisions we had made a few years back. And that's kind of a tailwind coming into 2022, as Peter said, feeling very strong around where we're going, in spite of the fact, and you already alluded to that things may be choppy.
Okay, good. Setting us almost up for the real question, but I have to ask my friendly peer and friendly competition from DBS. How is DBS doing? Are you outperforming me or not?
I mean, that would be an easy one. Yes, we are. But I'm just joking, Kai. I can see, I think overall banks have done well. But from a DBS perspective, we are very pleased with this year. Not only because revenues have held up and we feel very pleased with where we are versus our targets that we set for ourselves. But I think a lot of very positive momentum, and I'm sure we'll talk about it. For example, our supply chain finance business has grown, almost 40%. Our rate of digitalization has almost doubled in traditional trade. We've managed to really get a lot of customers excited about APIs. Our ecosystem and platform strategy has really taken off. So a lot of very, very positive, long-term thematic, items which are coming in, falling in place nicely. So as as Peter and Atul said, we are very excited about where we are and looking forward to the future with confidence.
That sounds good. So looks like my friendly competitor had a very good year. Same for Stanchart. Like the team here said, we also had a pretty good year, and I'm particularly happy that we've grown across all our trade business. We are probably going back to 2018 level. 19 was a really okay year. 20 we tanked, and now it's coming back to 18 levels, so substantially growing our business. Quite happy with that. Sets us up for our region and Asia. So we are all coming out of that pandemic. Hopefully we are coming out of this pandemic. The question for us is Asia, who was kind of leading the recovery in the world, is this slowing down? Some data points I saw, it's a little bit wobbly right now. The question is, do you see the same wobbliness I see here? do you see the same slowdown in trade flows in Asia, and how does our region continues to outperform what the other parts of the world are doing? And let's talk also a little bit about the dependencies with other regions. And I'm not going around the house, just jump in just to kick us off, maybe with Aseem, and then anyone else who wants to chip in here.
Hi, Kai, thanks. Yeah, look, we're halfway through our fiscal year, and performance has been very good. And I think the geopolitical landscape is so dynamic and changing so quickly that it remains to be seen what impact it's going to have, on a continuum as far as the trade flows are concerned. I can tell you that the impact on trade flows, with the pandemic over the last 18 months or so, has forced clients and supply chain intermediaries, such as banks, to reevaluate all aspects of the trade flows under the new normal, if you wish. FIs have a key role to play advisor and enabler, especially on paperless trade and other forms of digitization, funding, and risk management requirements through the client's supply chain. So, I think in transaction banking, we tend to be very good at being agile and responding to the changes in the supply chains and the geopolitical landscape. And it just means that we just have to be much more proactive and anticipate and address the new landscape. So I think that agility has been important and will continue to be important.
If I can add, I think to your question, do we see a slowdown? Actually, the answer is no. First of all, I think the Asia production machinery still continues very strong. So there have obviously been lockdowns, but I think those are somewhat temporary. So we don't see any structural issues. We see three key trends driving trade flows and trade finance business in Asia. We're seeing exceptionally strong demand coming from the US and Western Europe. I think that'll pick up and get a little bit when Asia comes back from a consumer demand perspective next year. I think that'll continue. So that's just the big macroeconomic piece. Secondly, I think what we are seeing is when you talk about shortages of semiconductors and when you talk commodities in the broadest sense, I think prices are up. Crude oil is record highs, et cetera, et cetera. So I think that's flowing through at an invoice level in terms of sizes. And then when you talk about the supply chain and logistic issue, lack of containers, et cetera, what that has created is, and it's been made a bit worse by COVID issues. So what that has done is created much more demand for working capital. So all these, I think, are generating far more flows than what we have otherwise seen at this time of the cycle. So we look at where we are today and where we will be probably next year with extreme high level of positivity.
I may take the other side of that one then, just to create some debate here. But I think that for me, I think Asia looks wobbly. I think the globe looks wobbly. And from my perspective, it's really all about stagflation, right? Which I believe will cap trade growth for the better part of the next 12 months, irrespective, to Ajay's point, of the speed at which individual countries or regions come out of COVID. Ajay just hit on that. Global corporates are dealing with higher costs across the board: transportation, labor, manufacturing, and these supply side challenges are impacting clients in a fairly significant way. We've seen clear evidence of that, even recently with the results of IKEA and Amazon. And these increased costs are not being absorbed by these global corporates. They're fighting to protect their own margins coming out of COVID, and they're passing these higher costs fully on to their end customer. And this will, from my perspective, constrain what might otherwise have been more robust kind of post-pandemic global trade growth, given the amount of pent-up demand that I think Aseem and Ajay have alluded to is in the system.
Maybe just to add on to what Ajay and Atul said, and actually picking a bit on what both of them said, I think we are, I mean, consistent with what Atul is saying, I think there is a bit of wobbliness, but I don't think we're going to see it immediately. There's going to be a bit of a lag effect before it really sort of impacts trade flows as a bank sees them. But conversely, to Ajay's point, we are looking at a serious increase in demand on working capital solutions, given the situation clients find themselves in post-COVID and on the stress on supply chain. So as a bank, we're sort of really optimistic about receivable and payable side solutions, because just from a client need perspective, irregardless of the nature of flows, those solutions will be increasingly more in demand and increasingly important for resilience, which, as we all know, is a key theme and will continue to be that through next year. Consumer demand, commodity prices, China, lockdowns, all of these other themes will play into next year, and we'll see how all of that plans out. But personally, optimistic that we will have peaks and troughs, but on even keel, we'll be better off than we were.
Yeah, I would agree, Kai, with Kanika, and I think the only additional thing I would add is that I think as the economy comes out of this cycle, I think we're going to see a lot of investment-driven trade growth as well. So I think some of what Atul talked about in terms of a slowdown on the consumer side and the absorption of the increased costs, I do think what we're going to continue to see, and we've certainly been seeing in this, is increased capex and the trade related to that, particularly around green energy, electric vehicles, aircraft, and so forth. So I remain optimistic about the year ahead.
Good. And why don't we stay a little bit on the supply chain topic? So I picked up two themes here. One, the opportunity created because of the working capital need, more financing potentially happening for us than we would normally see where we currently are in the cycle. On the other hand, we talked about the threat. So let us zero in on the threat of the interruption of supply chain, increased costs, etc. And if I look into my personal life, I'm trying to renovate a place in Germany. It is next to impossible to get simple raw material, which you have for white goods and anything at a reasonable price. So it is absolutely hitting the consumer. From personal experience, I can echo that the prices are passed on. If you renovate a house, you may want to pass it on because my bill is currently 50-60% higher than what I've expected. So let us zero into these costs and interruption. From my perspective, two key elements for supply chain. One, the resilience of supply chain and the prioritization of supply chain. And if you agree with me, if it's prioritization and resilience, how do you address it for your organization? How do you help your client to be prioritized in their supply chain? How do you help your client that your client is paid first before the other client is paid? And how do you help secure these supply chain, making them more resilient with the inherent risk we've just talked about?
Maybe I can help kick this off, Kai, if it's okay. I see the supply chain question from a few different prisms. The first one is, of course, we immediately think about disruptions and the geopolitical shift, right? That is one. But clearly what we have seen, despite the talk almost 2 years back about this, is that it actually takes much more to shift entire supply chains. So it might happen over a longer term, but it's not so easy to lift and shift supply chains. The second thing is that Asia as a whole, without talking about specific countries, has certain inherent benefits which continue to be valid in the post-pandemic era. So I believe that Asia's predominant position as the key part of global supply chains is safe. Within Asia, yes, there might be certain shifts, but I again don't see it as being a revolution. It will be more evolutionary, which means that one might talk about moving to lower cost for low value added manufacturing, say from China to Bangladesh or Vietnam or India. But overall, I don't think it is a knee-jerk reaction is going to happen on a wider basis. The second thing, from a resiliency perspective, and this comes back to supply chain disruptions because of COVID, because of logistics issues, and because of energy costs and shipping. I think the main problem to address here is actually, and I know I probably will sound like a broken record, but it's actually about digitization. Because today supply chains are so badly fragmented, and we still think in silos, and we still trying to solve this problem using 100-year-old, 60-year-old technology. That is why part of the reason exists. So therefore, I feel that, and there's a lot of great work happening in Asia. So whether it's Singapore or India or China, you can see that regulators, ports authorities, customs authorities, banks, logistics providers, they're all starting to work together to try and sort out this problem. And I'm optimistic that this is the way to go, and it is making progress. Will it make uniform progress across the region? No. But will we make significant progress in the medium to short term? Yes, that is my belief. And the third bit, which I will say, is this, right? We've never seen the use of data in the way we are seeing now. So what I mean by that is that in the past, it would have been left to each individual cog in the wheel to figure out its way forward and how to keep moving. Whereas I think we are seeing the use of data to actually orchestrate at a better level. And that includes, financing the smaller players such as SMEs, and which is where the supply chain financing issue, as an adjunct of the supply chain question, comes into play. I think that there's been a big change in the way banks and also various financiers look at the smallest micro SMEs who also need financing support, but usually are forgotten when we talk about supply chains. So this whole move towards deep tier financing, use of data, not necessarily asking the biggest anchor to provide all the data, all the support, almost a virtual guarantee and all the data, and putting too much of pressure on a single large corporate is also going away. And we're starting to move towards more predictive analysis, use of data, user flows, transactional lending, peer-to-peer, decentralized finance. There are so many changes happening in the way we finance the smallest entities. I think it bodes well for our democratization of supply chains and therefore a greater resiliency.
Thank you. So I was just going to add a voice of customer lens to what Sriram just mentioned. We commissioned a study with the Economist Intelligence Unit in the Q1 of this year, and resounding with what Sriram said, about 175 global supply chain managers were interviewed, and of them, I think 70% mentioned that they were considering in the next 12 months a relocation. And to Sriram's point, these relocations take time. They don't happen overnight, but there was serious thought and consideration. And in addition to the usual suspects of India and Vietnam, etc., Malaysia, Australia, Myanmar, Korea, etc., found notable mention as locations where supply chains would get engineered to. And I think the other interesting point on digitization that these supply chain managers brought up, 40% of them said they're spending at least 50% more on digitizing their supply chains, both within the organization and in the way they connect to their financing partners. So entirely agree with what you mentioned, Sriram, and clearly our clients are obviously thinking in the way that we are voicing today.
Could I just add to that, Kai? I think what Kanika says, one of the other themes that we've seen, though, is that if we were talking 2 years ago, it was a case of where else in Asia might you be moving your supply chain to? What we've seen in the last 12 months as we think about resiliency is a huge shift towards reshoring. We did a recent survey of about 800 US clients, and 70% of them said that they were considering moving their operations back to the US. And I think that comes down to the resiliency point with a lot of the disruption that we've seen recently. And you could argue that the environmental and sustainability element is playing into that. I think a lot of companies are not just chasing the next dollar of cost save, but also thinking about resiliency and hence manufacturing much closer to the end destination of the goods. And I think that's something that has certainly shifted in the last 12 months.
Ed, do you like to comment on this as well?
No, I think that's a really key point, isn't it? That the onshoring of the supply chain. I mean, I think that there's a number of things that have happened. The sort of the rise of nationalism in a number of the developing countries, the ongoing dispute between the US and China has left I think a lot of uncertainty. The cost of shipping goods, the cost of manufacturing in some of these locations, the uncertainty, I think particularly Southeast Asia, where a lot of manufacturing was moved to, just how slow it has been to come out of the COVID. The fact that some of these countries are still have a lockdown, are still relatively limited in terms of capacity. The impact that's having, the pile up at US ports, etc. It does make a lot of sense, and I think that it won't be an entire shift. I think that companies will look at this as a percentage. That how much can you make onshore close to your home market location versus how much you should offshore. And I think that it's that split of production, and maybe it's more than 2 locations. It's that split of production that I think a lot of companies are considering now.
Okay, thanks. That was pretty rich and a lot to digest for our audience, because I think every one of you brought different aspects in, which I would subscribe to all of them. We absolutely need to zero in a little bit more on the digital strategy. Also, would be quite interested to see what is your platform strategy. Are you equally bullish like I am on future of trade sits with a procurement platform, e-commerce platform, etc. But let me go quickly back and just some of you add to this topic dear to my heart. Living in Asia for 16 years now, reading every year the ADB gap report in terms of the growing trade finance gap. I don't know whether you saw the latest. We are now at 1.7 trillion, right? It's an unbelievable large number. Unexpectedly, it has grown from the billion which was hovering around with a pandemic. And addressing the point Sriram made, right? The data is the key element to get the financing where it's needed. In particular, with this group of our banks, we go after the big boys. Everybody wants to lend to the same type of clients. This doesn't bridge the gap. So, question for us here: how do we actually bring the gap to a place where we feel good about that we have actually done something about it? And I think it was Sriram who interviewed us 2 years ago, same question, and we thrown in a couple of ideas. Guess what? Nothing has happened. So let's make it a discussion where we find out an action item which we follow through and we find a way to bring the gap down. Is it data, like Sriram said? So Aziz, maybe you want to chip in. Is it data? What is it? What brings down the trade finance gap? 1.7 trillion. Hallelujah.
Maybe I'll take a shot at this. I think, first of all, it depends on the customer segments, right? So if you go after the big boys, there's still a path to creating this, narrowing this gap. But really, part of this has to be that you have to have broader customer segments that you really deal with on a regular basis. So we do at HSBC. So we do deal with business banking and middle market clients quite extensively. I think part of the answer lies in data. So we've now started using digital decisioning. So we don't look at balance sheet and financials. You look at the ecosystem in which these customers operate in. So at least you can touch and scratch the surface, as it were. It's a big gap, right? But equally, there are other ways of skinning the cat, as it were. You probably look at multilaterals. So we have tie-ups with ADB and some of the others to really get money in there. I think regulatorily, there is need for work to be done, and I know we will talk about that later. But availability of insurance to mitigate some of the risk, or at least share in some of the risk, is again another way to close these gaps. But a lot of work needs to be done. I think digitization, and we'll keep talking about that, is really a big trend that will support closing of this gap.
Yeah. I mean, I'm just, from my perspective, I'm just hesitant to put all of the eggs in one basket in terms of digitalization. It's going to give us a lot of insights, no doubt. But the same problem today is the same problem 2 years ago, 5 years ago, 10 years ago, is that there's just an awful lot of banks. We're all comfortable lending to the big, large companies. Does it really pay for us to go down to the SME and below level in various countries that are, obviously not our home or not our key markets, segments that we may be less familiar with? more and more the rise of financial crime, some very high profile cases in the last 12, 18 months. Maybe that's even taking a bigger role when we think about financial crime than we think about credit risk. So when we talk about, the start of these supply chains, which SMEs really need that funding, it's not changed, right? It's similar countries. It's difficult to lend to corporates. Do we feel we've got the on the ground knowledge, etc.? So yes, the digitalization may point us directly to who to lend to, but it doesn't probably change the same issues we've got if we don't have partnerships with multilaterals, if we don't have some relaxation in terms of what RWAs we need to hold against these credit risks. Then it can't just be one element. I think it's got to be the entire financial ecosystem that's got to move towards this, not just banks.
If I may add to Ed's comments, when we want to narrow this trade finance gap, one of the objectives that we have at Santander is the financial inclusion, and in order to do that, you really need to go down to lower segments to know what your customers are doing, what are they trading with, and in order to do that, in order to make it viable, you need to have a large market share on those countries that you want to go lower on the segments. And to do that, also, if you want to expand your exposure on those segments, you need to have a proper ecosystem in terms of legal, insurance. It was mentioned also, government support, and also digitalization helps a lot. I think we are far away still to be able to do that in a massive scale, but digitalization is helping, and the governments are very, very aware of the need of supporting that trade finance on smaller segments.
Yeah, Kai, I think both what Ed and Nicholas said is absolutely dead on. Ed's comments at the local level, the grassroots level, around our various bank strategies, and what Nicholas said, at a global level. So, and I think, as we saw with COP26, one of the challenges that they've been having in the recent discussions has been around developed, richer countries providing support to, underdeveloped countries around some of the sustainability initiatives and the impact that's going to have on trade. And I think part of that, to your earlier question, Kai, although I don't think this is directly related to data, I think without that standardization, which is, I think, what Nicholas was alluding to, and the interoperability between, the various governments and regions that are working on different initiatives, without that connectedness, I don't think that you can have a challenge using data to bridge that gap. So that's at the geopolitical level. And what Ed was talking about, I very rightly, I think, is very much what we are grappling with from a strategic perspective on a day-to-day basis.
I agree with everyone, and this summarized the challenge. I'm not sure we 100% correct how we address that challenge. And yes, if it's the HSBC business model, to some extent our business model, some of our banks here business model to lend to the SME business banking clients, yes, we are supporting it, but it's not cracking it. Just the thought, the ADBs, the IFCs of the world, yes, can't we link as bank a different investor base to this type of clients based on our supply chain? There's always appetite for risk. We just need to find it, because we will not go from a Stanchart perspective downhill to the smallest denominator. Will not happen. Doesn't sit with our credit appetite and profile. And that's probably the same answer for you. So maybe it is teaming up with our friends on the investment bank side. Let them find the investor who has appetite for the SME, package it, create a node and sell it. Food for thought. Let us move on and try to. Yes, Sriram.
I was raising my hand, maybe not visible. I just did want to respond to that because it's a very important question for us at DBS, especially given the focus on Asia and the SME segment in Asia. As you know, in Singapore, Hong Kong, we have a very, very strong market share, and therefore we take it very seriously. And I just wanted to say that maybe, and you started off us off on this question asking us, when I asked the question 2 years back and things haven't changed. Actually, I do want to maybe reset that question a bit, and I think things have changed. For example, you talked about wanting to, do up your house in Germany. A few years back, you wouldn't consider doing it sitting here in Singapore. Today, you're considering it, meaning that something has changed in the way we approach our lives digitally. The stuff that we buy, about 50%, 60% of it now we buy through e-commerce. So we don't really need to go to the malls as much as we used to do in the past. So I think life has changed. The phones play an ever-increasing part in our lives. And I think that is why, at the risk of sounding, potentially deranged, I feel that digital and data potentially holds the answer. Now, I don't mean to discredit any of the other considerations, which means that you have to be the right bank for the right country and for the right segment. Of course, I don't expect that if you are a large European bank with a smaller operation in Asia, you cannot go all the way down. But that doesn't mean the entire banking system cannot. So there must be portions of it that we can address it in our respective home markets. And the second thing is that we can't approach this problem with old lens, which means that we can't say that I look at customer credit. How do I deploy credit in the old-fashioned way? Which means I can't ask for financials. I need to look at transaction data, be able to use it in a different way. I don't think as banks we have gotten there yet. Frankly, banks are being disrupted by 3-year-olds and 7-year-olds simply because they are not thinking the way we've been trained to think for the last 50 or 100 years. So I think there's a big sea change in thinking that is required if you're really going to crack this $1.7 trillion gap. I don't think we can use traditional means. We need to really go beyond. We need to take some big bets. We probably need to look at how do we tie. You brought up a good question, point on tie-ups, and the tie-ups may not necessarily be looking upwards with insurers and investment banking kind of targets, but really to the grassroots. How do you get data and how do you deploy using decentralized measures down to the grassroots so that you can rely on that kind of data to really say, okay, I can see paper use is a big thing happening, not in bank space, but in the fintech space. Paper use is an important change. Subscription-based models are coming in. Buy now, pay later is coming in. I can keep going on. There are winds of change all around us, guys. And as banks, I'm very passionate that we need to move in that direction if we're going to address this problem. Thanks.
Yeah, love the optimism, Sriram, and that's perfect segue into our next topic. We have to talk about digitalization in trade. So one way to look at it, and this forum discussed digitalization a couple of times, and then I can put all of you on the test and saying, how many digital export LCs cross-border have you executed? I'm not putting you on the spot. However, digitalization came through various aspects which we have discussed already. And where the digitalization, from my perspective, plays a massive role, and we've touched it, is in the platform space. In other places as well, mobile, Sriram just mentioned it, data, let's talk about data, but let's not forget in data our regulator. Are your credit models approved to use data as a source to underwrite credit? Question mark. But let's go back to the platform question. Are you seeing optimism in going onto a platform strategy? And maybe Peter, I go to you first. What is your digital strategy? Look at it from a platform perspective. We started very successfully with LinkLogis. Hopefully, we can do more in the region with our friends from LinkLogis. We are now teaming up with them to develop a distribution tool with them jointly. Good co-creation, our friends from LinkLogis. This is good, but there are other platforms out there. There are other digital initiatives. Well, play this back and let the audience also know where you're actually making tangible progress, like in dollar and cents, client satisfaction, growing markets. Peter, why don't you go first?
Yeah, thanks, Kai. Well, I think there's two main parts of this. There's the bank and client relationship, and then there's the interbank or the industry piece. And I think they're very different. But the thing I would say at the outset is I really do think the pandemic has had a hugely positive impact. And why do I say that? Regulators are now looking at this very closely. I think before, it's fair to say we were all focused on this, but we didn't have the support to drive the legislative agenda that would underpin a lot of the digital tools that I think we would all be striving for. So I think that has changed, and I think that's positive. On the interbank piece, I think there's a long way to go. I think with Militer, we're starting to see, and other similar initiatives, we're starting to see regulators underpin what we need. I think a lot of the industry consortia that many of us are collaborating together in are going to take us in the right direction, but that will take time. This is a very complex ecosystem. Banks aren't the only ones that are part of it. I think on the client to bank side of it, there's a lot that we can do, and certainly at Bank of America, a lot we have been doing to try and fully digitalize the client to bank experience, albeit that may need to evolve as the interbank and industry level piece starts to take shape. And it's very simple things. It's still simple back to basics, like driving paper out through electronic platforms, increasingly digital onboarding and servicing, e-signature. Don't sound like very exciting things, and they're certainly not new, but in the last 12 months, they have got traction that I have never seen before in my career. And I think that's positive. So long way to go, but I think the last 2 years has certainly been a catalyst.
Maybe to just augment what Peter was saying, it does take a village to digitize. And I think on our own little homes, we've all done the best we can. I'm sure every bank here has impressive statistics around how much more their clients are using their platforms, or how much paper they've saved and eliminated. And, we have a greener planet as a result. But I think the real benefit and time save and efficiency comes in when interoperability comes in. And that needs governments, that needs shipping agents, that needs insurance companies, that needs data standards, that needs acceptability of electronic signatures, legal frameworks. So the journey is a long one. We've done a little bit in our homes, but as a collective village, I still think there's a long way to go. But thankfully, the pandemic has brought to fore that this is a critical imperative. And I think we're all going to put our arms together, hopefully, and be collaborative about this, because without that, the village ain't moving forward and becoming a big town.
If I may add to that, there is another perspective to this. In Asia, documentary trade indeed is one of the main products to be used. But when you look into Europe, open account, it's much more stronger, and digitalization in open account is much it's moving forward very quickly, because there are, as Kanika was saying, less people involved. So you don't have all these intermediaries involved in documentary trade. In open account, you have your invoice connected between the buyer, the seller, and also the even further down the value chain. Indeed, in documentary trade is a challenge to be able to be end-to-end digital as the too many counterparties involved. But you need to start somewhere and having an interface to our clients, and being able to have interface further down the road. And also standardizing the way of communications on how these documentary trade milestones are being achieved. It's a big challenge, but it's been moving forward quite nicely lately. And on open account, I believe we have it's a low hanging fruit, and we can do it quite faster, as there is less people involved in the middle.
Yeah, but I think open account is the easy piece, right? It's already totally 100% digital in any case. So it's the papers and the traditional trade, as we call it, or core trade. So how do you get rid of that? I think Kanika talked about interoperability, and we're beginning to see some of that take place. So there are transactions now that we've done around the E-Trade Connect and PBOC's trade finance platform. So that's working. It's still single digits. A way to go. Blockchain started off. We are at least getting to 3 digits. So I think there is traction taking place. It's still not where it needs to be. It takes time. It takes connectivity at both ends, and again the buyer sellers coming together and finding benefits. So I frankly sometimes think the letter of credit savings for us are marginal. The benefit is in the customer back office, right? So for them, digitizing their back offices is where the prize lies. And I think customers will get there. Unfortunately, they'll get there in their own time and pace.
I would just add to what has been discussed is I think one other major challenge is on the absence of global data standards. And I think this is requisite, to build scale. But the adoption or the development and adoption of it is, I think, going to be a big challenge. And I think to make interoperability successful, I think underlying all of that is the requirement of global data standards. I know there's work that's being done on it, but I think until there is mass adoption of that, it's going to continue to be an obstacle.
Yeah, I agree. And if I may interject here to put a different angle into digital, we talked a lot about the client lens, and I would again 100% subscribe on everything we've concluded here. But let us look from a back office end and a governance end. Are you investing into digitalization? Fraud detection tools? We've teamed up with our friends in Quantexa. We're having very good results, and we are looking them against the human brain. And it looks like the Quantexa brain is smart enough, maybe even smarter, to find the cases which we are going after and investigating. So that's a real data digital use case. It's not the front end, but it's helping us on the back end. Would be really helpful to hear from your side. Using that for efficiency, how are you digitizing your back office, if you are, or from a governance perspective? Let us take a quick swap in lens where digital is helping us. Are you investing? I don't know, Artur, but I should put you on the spot. Is that a big area for you guys, investing into back office technology? You get more efficient, better governance?
We're absolutely investing there, and that's probably been where the majority of our investment to date has really gone in the digital journey for trade. But and I wanted to kind of comment after Ajay and Azim, only to say that I think all of us can come up with really cool sound bites for things we've done, and probably perhaps to the ire of a few people on this call, I actually don't believe global banks have either really the willingness or competence or even the mandate from their shareholders to truly disrupt themselves, right? Without some form of really established competitive threat. I mean, everything we're talking about is kind of large scale innovation, but it's on an existing business model. And I think Sriram talked about that in the last question, which is what's being financed, the way we finance. I mean, that's fundamentally changing. And I just think we're very ill-equipped to kind of handle that, because the way that we've been prosecuting the business, even if it's more digital, even if it's more efficient, is still largely the same for decades, right? And so a lot of the benefits of transparency, flexibility, speed, inclusion, which we talked about when we kind of addressed the trade finance gap topic, are simply not moving, or certainly not moving in the right direction. So again, very controversially, I feel like the shot in the arm or the impetus that we as kind of global banks need to be maybe more bold will really come when large non-traditional players step in to provide trade finance, much as we've already seen in payments. And I think for some of the reasons people have already covered in prior answers, I think there's a real possibility of that in the next 5 years, given that mass adoption of e-commerce, the large sets, as you mentioned, of seller and customer data these platforms are sitting on, via which they can assess behavior and various forms of risk. And also, let's not forget the very large balance sheets that they have to play with, right? So, trade finance globally is a $50 billion revenue pool, and I think that's ripe for disruption. So yes, sorry, long answer. Short version, we're absolutely investing. We're very serious about doing things smarter, cheaper, faster. But as I said, I feel like we're just kind of innovating at the margin as an industry.
Artur, I absolutely love the answer. I think all of us need to meet over drinks and dinner. Then we come up with that idea with all that knowledge on the phone. Then we incorporate ourselves and all of us go IPO. Because I couldn't agree more with you. It's not happening, right? With all the excitement, we're all super digital here. but it is not the change in business model is not happening. This exactly, you summarize it so well. We have our traditional banking model, and then we see a little bit disruption, and then we are laying over that, over our unstructured data, digital tools. We think like bankers think. How do we get out of that? How do we think like the Googles of the world? Food for thought. Let us go IPO, all of us. More serious business and not us IPOing. Any more feedback on digital strategy and also the back end would be quite interested how you're investing in governance or operational efficiency if you want.
That we do need to change the way we look at the cost to serve for our business. And therefore, we need to do a few things together as an industry, which is look at, you talked about Quantex and your tie-up. The TBML piece also has to be digitized, and therefore the cost to serve has to be reduced. Similarly, we have to think about what is the customer experience. Today, it's really bad. So if you're going to survive as an industry, we need to definitely change the way we offer this, to our customers. And finally, I think it cannot be done even within the banking or the financial services industry. It has to be done across a wider cross-section, and regulators and G2G efforts would be required, which is where the M letter piece comes in.
Okay, good. Thanks, everyone. Let us change topic to something very close and dear to my heart, our environment. Living in Asia, it is part of everyday's life. That even in other parts of the world is critical, important that we live to up our values. Most of our banks, all of our banks have announced net zero targets and sustainability targets. But what does it mean in light of COP26 is with us? What does it mean for your business? What exactly are you doing in the sustainability space with your clients? How do you implement what our clients are doing? And observing what sustainability means for trade, I've always seen our clients quite often in the forefront in the thinking. Their physical supply chains are quite often already sustainable. So we as a bank are catching up to sustainability financing, overlay this with a physical supply chain. So would be really interested to hear from this group here for our audience. What are you doing? What tangible examples you have? And the more tangible you can make it, the better it will resonate for our audience. And the goal here really is, how do we duplicate what we learned today? Because this is when we absolutely want to steal with pride, because it solves the net zero issue. So if our friends from DB or Lloyd's have a good idea, let us all listen. And how do we duplicate this? I don't know who wants to go first. I mentioned Ed.
I can jump in, Kai. I mean, so I think from the Lloyd's perspective, I mean, obviously, with our dominant position in the UK, I mean, with a number of clients that we already had, I mean, is a particular client in Scotland, large wind farm turbine producer. I mean, their demand from all over the world has just gone, tenfold in the last 24 months or so, and that's only increasing as more governments make more funding available. So, what have we particularly done? Not only increased our limits and the facilities that we provide them, but also introduced them to ECAs in various countries to support us and to support them to export more. How do they manufacture more? Well, can we lend money to increase manufacturing capability? Use the UK government, for instance. The UK government have offices to support UK trade in most countries around the world. Can they produce part of their manufacturing process in cheaper locations? This is also going to help to get simply more wind turbines out there. So I think that, we've got some really good stories like that. We need more. I think that, I think probably with this ESG Green Initiative, I think that many banks have made the commitment. We all know that. I think we've seen great behaviours, like the Scottish example. I think we've seen bad behaviours. An example of bad behaviours, to my mind, is there's probably a number of transactions which are exactly the same transactions we would have done 3 years ago, but except now we're calling them green. We're putting a green angle on exactly the same loan that we would have done before. Some people call this green dressing, and this is is not helpful. So I think probably on a country to country or a regulatory level, it's something that holds everyone to account. What is truly a green deal, rather than us bankers saying it for the benefits of our board members, our shareholders. I think that to call it a green deal, you have to have some credentials that back that up, I think.
Yeah, I mean, I think I loved Ed's response. It's very similar to Kai, what I would have shared. I mean, in terms of what we're doing, it's largely, kind of following what Ed has shared. So, green pricing on our supplier financing. So, better pricing for better behavior and vice versa. Sustainability linked loans, project finance with a particular focus on renewables, which is following from, what Peter had mentioned at the beginning around, the government-led infrastructure investment into the region. And so, in short, I mean, there's a lot of genuine intent and important work to do to make trade sustainable. We know that. But actually, and that's why I loved Ed's response so much, I'm equally concerned about being pushed as banks to move too fast without first having a clear market-aligned standard for helping global corporates do so. Without which we run that very real risk, as Ed said, of mixing genuine sustainable trade finance activity with what I've kind of read it described as, which is greenwashing, right? And I think this risk is particularly high in the short term because, at least from my observations, our clients are seeking our advice and our support on how to finance their transition to green. They're already operating very large, complex global businesses. They need our help going on a journey from A to Z, and it's not going to be one stop. And then when it comes to assessing the timeliness and the quality and the impact of that transition, I mean, that should ideally fall into some sort of independent and recognized framework versus, to Ed's point, being left to the parties involved to assess for themselves. And when I go to your question now, I mean, looking at COP26, I mean, and only picking up what I have in the press, I think that risk is only further amplified because you look at the progress that's been made on fairly fundamental topics like carbon trading. Despite this being like a core hangover topic from 2015 in Paris, we're still not there, right? And when you look at the commitments that most nations have made, on carbon neutral, we're talking about decades, that they bought themselves, despite this being described as a situation where I think it was, 1 minute to midnight was the phrase, right? And so I think without clear leadership on this framework topic, banks will continue to have to muddle through and rely really on their own best judgment to help global corporates navigate the change that we all believe is necessary and right. So, we'll continue to do what we believe is right, but unfortunately it is truly what we believe is right and not something we can readily or easily affirm as kind of a market standard.
Yeah, great. Arthur and Ed couldn't agree more on that. And this where we've done a lot of homework in Stanchart to come up exactly with that framework. And truth be told, as a banker, we are not the best qualified to judge whether something is from a sustainable source or is produced in the right form and manner. This is where the idea of the certification comes in. There are a lot of groups out there who think for us what is sustainable and certify them. Means the due diligence we need to do is then on the certification body and not so much on the transaction. The framework is absolutely critical. But I want to bring also our friends from Santander in. I know Santander, a leader in sustainable finance. And Nicolas, if you don't mind, share a little bit what you guys are doing.
Yeah, so Santander is been committed to sustainable finance in a wider broad, meaning we have a plan which is called responsible banking, which includes financial inclusion, which we were discussing before with the trade finance gap, we include sustainable in terms of governance, how to include different segments of society. And when it comes to renewable energies, we are fairly ahead in terms of our commitments to finance. We committed ourselves 120 billion, and we are quite ahead on that front. But also on the other front, refraining ourselves from financing fossil fuels and coal-driven assets, or exiting clients which are taking that energy transition in a much weaker, slower way. So we are trying to live to our responsible banking standards. And when it comes to frameworks, we're trying to help. So we see this as an opportunity to our clients are giving us to participate on their effort to transform their business, if it's energy transition, sustainable supply chain, whereby we can offer, as Atul was mentioning, grid margins in terms of supply chain financing, depending on the effort and the investment they're doing. So we can shoulder a little bit of this effort, and we can shoulder through different solutions, bringing also knowledge in terms of, you were mentioning, Kai, about certifications, bringing some standards in terms of how to make that being certified, and also those KPIs to be followed through. Indeed, it brings it's quite a long journey to be able to bring all those pieces together: the customer certification, the projects that you can put on top of them, you can tag as sustainable, and trying to avoid the greenwashing. Although on the greenwashing also, there are some assets which we didn't think of them in any other way, but plain financing. And now we can differentiate whether this financing it's on the positive side, or this financing is rather on the against sustainable targets. So it brings a lot of effort, and indeed some standards, banking standards, will be very helpful to keep on pushing on the right direction. And as Atul was mentioning, whether we're going too fast in this transformation, and we are putting ourselves in a difficult situation, it would be very useful to see other stakeholders to help us on aligning this framework.
Couldn't agree more, because that can't be each and every bank defines its own framework, which helps to give guidance to the clients. But as an industry group, we need to come, and I think, Atul, you mentioned that, right? The industry needs to come up with standards which are then rolled out, because only with those standards we will get scale. Eleanor, how are we doing in terms of time? I think we need to wrap it up with the outlook.
Well, I'd like to hear from Peter, because I know that he's got a bit of input that he wants to give on the ESG front, and then I will go around everybody with the closing questions. So over to you, Peter.
Thanks, Eleanor. You must have seen me chomping at the bit. I just had, I agree with a lot of what has been said, but just two things I would add. Number one, clients were more focused on making their own businesses sustainable. And I think what they're now realizing is that in many sectors, 80 to 90% of their environmental footprint is in their supply chain. And that's not where green bonds or sustainable finance come in. That's where trade and supply chain finance comes in. And we've been working on a number of solutions that are actually helping clients drive that environmental discipline down into that 80 or 90% of their supply chain that is outside their own house, to use Kamika's term, but increasingly their investors, their lenders, their customers, and their employees are caring about. And I think that's where we have a role. The second thing I would say is when we say sustainability, we focused a lot here on the environment. That's very important. But increasingly, many companies and their stakeholders are looking at environmental, social, and governance. And again, that's where I think we as trade financiers come in, because it's not just understanding the environmental impact of their supply chain, it's providing them with insights and data that help them see whom they are dealing with in their supply chain, and do those participants have the right standards of employment practices or ethical sourcing or whatever. So clearly environmental is topical at the minute, but social and governance, I think, particularly for the new generation of investors and employees and customers, going to become very, very important.
Fantastic. thank you all for some really, really fascinating insights. I think one of the things that comes out a lot is this feeling that we're still not there, right? But on every front. And as I think Kai mentioned, a couple of years ago, when Shriram asked us all about the trade finance gap, and we're still, the trade finance gap's got wider. And Atul mentioned, we talked at Paris about carbon credits, and we're still not there. So, at risk of this being yet another talking shop, I thought it might be good if we close off by saying, all right, what actually needs to happen so that the next time we gather, we're not once again saying we're not yet there. And also, if you can give solutions, that would be great, obviously. And also, what are you most concerned, optimistic about over the coming months? I'm going to go around all of you, and I will start with RJ, please.
No, thank you. So I think we at HSBC are very positive in terms of the outlook. Our view is that there's a significant growth opportunity, especially as the Asia consumer demand recovers. Now, digitization is a given, and it's therefore, how do you use data that we all have coming into our bank every day to develop new solutions for our customers? Just be careful, not products, and using data. And therefore, how do we engage with our clients differently too? Because with digitization, every customer is on a digital channel with us. Are there different ways of engaging with clients, connecting with them, finding opportunities, solving their problems? I think the other thing which the bank is really excited about is everything around how do we transition to a low carbon economy. And our view there is that things will move really, really quickly. The industrial revolutions or cycles take 15, 20, 30 years. This will happen faster. So it's about not just offering, again, products into our clients. It's about helping the clients make the transition and being able to work with the new technologies that will come to solve the problems for our customers and for ourselves. So very exciting, but lots to do.
Absolutely. Kanika, over to you.
So all the Ds, data, digitization, deepening the footprint, and developing ESG solutions. I think if we put all of those Ds together, a lot to do, as Ajay said, early part of that journey. But I think what we are very, very excited about is the time we've spent in approaching our clients from a holistic ecosystem perspective, as opposed to solving just for their individual balance sheets or their individual manufacturing. And we think that as a trend will continue. To your earlier question on what we will be talking about differently, hopefully when we get together as a group, I think leveraging data more effectively is something all of us will necessarily have to do. I don't think that's an option. And hopefully when we connect next, it will be a far more integral decision-making tool than it is today. And especially transactional data, where as transaction banks, we are at a goldmine of information. So that should hopefully be a place where we can sort of spearhead change and where we can spearhead innovation. And I think the other thing that will be hopefully spoken about differently on the green energy piece and the green sustainability piece is setting of standards. And I don't know if some of you noticed today, but at the Singapore FinTech Week, the regulators are clearly listening, and MAS announced Project Greenprint, which is talking about setting up ESG standards and a registry. So we think that's the way, for a lot of us to go in terms of participating and providing information to be a change agent. Hopefully, again, when we connect the next time, we would have a far more deeply imprinted strategy around that. And in terms of digitization, I think data sharing, data digital identities and standards around that, as SWIFT, BAFT, and various organizations are getting their act together. I think that's something hopefully where we'll have a little more concrete action as opposed to just talk when we convene next. But echo the optimism and echo the ability to be able to continue to add value to global trade.
Fantastic. Azim, over to you. What do you need to happen so that next year we're not having the same conversations?
So I think that the question on what needs to happen, what I think needs to happen and not having the same conversation is interrelated in that I'm very bullish on ESG. And, the data discussions we've had, the regulatory discussions we've had, the funding gap discussions we've had, I think is a journey, and it's been well, at least during my participation, half a decade discussion year over year. I do see ESG as more immediate. I'm optimistic that we will see further growth in the next 12 months and demand and delivery of ESG structures by banks as clients continue to demand higher ESG performance. In my experience, at least in the last 12 months, what I've seen is clients are actually coming to us, very sophisticated clients saying, look, this is what I need from a supply chain perspective. And the one advantage that I've got, my colleagues in my department, is that we do all of transaction banking products. So we can look at it from both the asset and liability side, whether, for cash management and for trade, and the matching structures from an ESG perspective that our customers require. Other parts of the bank also are very heavily involved: project finance, the investment bank, transaction banking. And so it's very immediate, our ability to provide these new structures, very exciting for us in product development. And that's what I'm most bullish about, I think, in the next 12 months, to see that continuing to grow.
Fantastic. Ed, over to you. What are you most bullish about over the coming months, and where do you see the threats?
Yeah, so in terms of, well, I suppose in terms of that very original question, in terms of how are we not back here in 1 year or 2 years' time, not having the same discussions? I think for us, there has to be an acceptance that it can't just be the banks alone. We're not going to be able to, to solve that huge gap. I think it's got to be at the government to government level. Am I bullish about that? In Glasgow, Russia and China did not turn up, so it's going to be, I think, a tough challenge. To keep having that gap there. ESG, no doubt, that's going to do multiples. Every bank wants to do it. We'll find ourselves in a position where we're all fighting over the same deal and reducing the price on some of these larger ESG transactions quite a lot. And short term, that's maybe not great for some of the business heads here, including me, but longer term, it's good for ESG. So yeah, if lots of banks are piling into that, good, because it's getting deals done at good prices.
Great. Atul, over to you, closing statements.
Yeah, so I'll maybe then follow a little bit the blueprint of everybody else. I mean, if there's something for me to be positive about, it's certainly at the institutional level, right? I'm definitely positive about DB and our ability to kind of grow our revenue, delight our clients with new solutions and outstanding service, innovate, and challenge our amazing people. But if I kind of take the context of this forum and really kind of now talking about the industry, I think I've probably hinted at that in this session, definitely tipping towards pessimistic, right? I think we still have too much work to do, too little to show as an industry, and on really fundamental topics, right? Inclusive financing, digitization at scale, sustainability, and to call it out, sorry, even gender diversity, right? Which this panel itself is, again, a stark reflection of. So it's hard for me to pretend that things will be massively different 12 months from now, because exactly as you've said, we've been having these same discussions for 3 years, but I can only continue to do my best to be critical of our collective opportunity areas. And I give you and Kai big kudos for calling that out right at the start and challenging us to think about how it's going to be different next time around. In that context, I think one thing I would say is that as an industry, we've got to get much better at driving change versus being driven by it and kind of pointing to regulators or ecosystem or as the problem sits somewhere else. And I think in that context, one tangible takeaway, since you asked us for one, is perhaps this group speaking more frequently than once a year at this forum, because we are the senior leaders of the trade finance industry in the region. And so Kai, I will take you up on that beer. And as things open up in Singapore, everybody's welcome.
That sounds like fun. I'll hand over to Shriram.
Thank you, Eleanor. And actually, I thought I actually agree with a lot of the stuff which has been said. And I agree, especially with Atul's point that I think next year, if we were to scorecard ourselves, we still will be talking about many of the issues we talked about today. So that is my note of sort of not so optimistic. I'm usually optimistic by nature. So what I'm really optimistic about is that I think the pace of change is quickening. So I do feel that we will start making faster progress towards some of the goals that we've been talking about. definitely because technology is an enabler. There are disruptors on the horizon. So we definitely, if we don't get there, there'll be other industry players which will get there ahead of us, and that will basically drive us also to pick up our pace. I think there is greater impetus from the regulators to work together. There are very good, especially in Asia. I'm really heartened that regulators like Singapore, China, India, multiple locations are starting to come together on a G2G basis, as well as within their own respective domains. For example, the formation of SG TradeX in Singapore, I think is a great step in the right direction to create a digital ecosystem and make things work faster. There is also the the NTP in Singapore again, which looks to digitize and improve the workflow for trade. So I think all in all, there are bits and pieces moving in the right direction, but will they all move in tandem at the same time and to the time that we want? I don't think so. But I think it's up to us in our individual domains as well as to collaborate, as Kai and Atul have called out, and also to actually be the voice of change with regulators from an advocacy perspective. There are enough bodies that we are in. I don't think we're using them well enough to actually make the change happen because we very quickly get disrupted by other things to do. So I think it would be good to sort of set some common standards and goals and work towards that. And last but not least, the customer is changing. And I really have said this before, but I think that I'm really optimistic that for trade, which has for so long been a stepchild, I think soon start talking about hyper-personalization, customer experience, going down deep to the smallest common denominator and not stay at the top end of the trade finance world.
Great stuff. I think really, really important point there about more collaboration being needed. Nico, what's the viewpoint from Santander on that?
So onto the original question on the outlook towards this year, we had a good year. Prices are up, volumes are up, new commodities are flowing, and we are seeing a disruption on the supply chain. And I believe this is going to be on the short term next year, still part of the topic on how to support our clients on this supply chain disruption, to support those trade flows, and perhaps, as I was mentioned before, to support those capex investments that we'll have to do to reshape the supply chain. And in terms of what we will be talking about next year, I'm sure ESG is going to be a step on top of the list. It's going to be, but I hope that I expect next year that we will be talking in a bit different way, with a bit more clarity on how to address this on different products, clients, and different segments, with a clear framework, a bit more clear framework on how to approach this and deploy our resources and support. At the end of the day, what we want is our clients to prosper and support our clients to transform. So hopefully in 1 year time, we'll be talking about those frameworks, how they've been outlined, roll over, and hopefully we will be talking about how to improve them, expand them, to have a more ESG friendly portfolios.
Great stuff. So progress on ESG we hope to see. Peter, over to you.
I think a lot of it has already been said, Eleanor, and I think I'm generally optimistic. And I think with the way that the markets in Asia are opening, despite the wobbles that Kai referred to, I think that's positive. Risk and uncertainty aren't going away, and that's actually good for trade. That's where we can help our clients with relevant and compelling and hopefully digital solutions. And I'm also optimistic that a lot of the phenomena that have been accelerated by this terrible pandemic will reach a critical mass. And I would never want to look back on the pandemic as having been a positive thing, but there are areas of our business where it has and will act as a positive catalyst for the future. In terms of what I think we should do differently, yeah, I agree with Atul. I think less talk and more execution, but at the same time, what will we be talking about next year? Well, I think we will, and we should be having the same conversations next year. Rome was not built in a day. These are major, complex challenges that require diverse and multi-year solutions. So this is an ongoing endeavor. I think, as I look back a year, the dialogue has advanced, and that's good, and that's a sign of progress. It will advance when we come together again, hopefully in person next year, but we will and should be talking about the same things.
Very, very good point. And last but certainly not least, Kai, let's talk more execution is what people are calling for. What needs to happen in the next 12 months?
Yeah, thanks. So first of all, thank you very much for having us, Eleanor. And I think that was a fantastic panel. I learned a lot. I think there were a lot of takeaways, little bit of controversy here and there, different viewpoints. That's what makes a good trade finance panel with an A team of trade finance here in Asia. From my perspective, normally German DMA, always pessimistic. There's always something to be grumpy about. This one, I'm hugely optimistic. We've started listening to our clients. Let's start with the bank clients. They want trade as a service solution, and we are working on something. I think I can talk about that next year. So a new topic, trade as a service. We also listen to our corporate clients who said sustainability is core and center. We have already cracked sustainable physical supply chain. Banks, get your act together. And I think we put a framework into play earlier this year. This is harvest time now, rolling it out, bringing it to our clients. And I think there's a lot more tangible discussion possible around the frameworks being developed. And then the last part, the digital aspect. Listen to our clients here again who are telling us, I'm tired of looking into this bank channel and that bank channel, and I'm a treasurer and I have a fishbowl full of tokens to look into all these different bank channels. So the platform strategy is getting more and more important for our clients, looking into one platform and then having their group of banks joining the platform instead of them using the fishbowl tokens example. We've invested quite substantially into many of the platforms, for procurement platform, distribution platforms, etc. Again, I assume this will be harvest time for us next year. So hopefully a lot more tangible items we can discuss. But again, big thank you for everyone. It was a really good discussion. And invite us again out if we are ever allowed to meet here in Singapore, ever. I will pay the first round of beer. Let's meet. I absolutely need to see our friends here back in the industry. I'm too often in that virtual office.
I think that's a sufficiently strong statement to end on, particularly a whole round of beers. So thank you very much, Kai, for an excellent moderating job. Thank you to all of you for joining us, and thank you as well to our audience.